According to Fed indicator, GDP is expected to drop by approximately 53% in the second quarter. The Atlanta Fed estimates that the gross domestic product will decrease 52.8% in the second quarter. The ongoing contraction in the manufacturing industry hinders consumption and private investment, two pillars of the economy. Such a big decline could portend a short-term burst, but that likely will be followed by a swoosh recovery, said market expert Ed Yardeni. Economic activity decreased by more than half in the second quarter, according to a viewer employed by the Atlanta Federal Reserve. The GDPNow viewer shows a 52.8% drop on Monday, following data showing that United States production will continue to decline sharply and focus on investment and consumption. Supply Production Institute data showed only 43.1% of firms that saw expansion in May. Based on this data, Atlanta Fed expects personal consumption expenditures, which constitute 68% of the country's gross domestic product, to decrease by 58.1% in the April-June period. The gross private domestic investment, which accounts for 17% of GDP, is now expected to slip 62.6%. The GDPNow reading is subject to regular revisions and is usually more accurate as it approaches the end of the quarter of June 30. In the second quarter, CNBC's quick update poll for leading economists dropped an average of 38%. The one bright side of the even steeper slide is that it could point to a sharper recovery, at least in the short term, said Ed Yardeni of Yardeni Research. He projects the third quarter to see a 20% rebound, followed by a 5% gain in the fourth quarter. After that, though, the situation gets cloudy. Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.